Imagine building your dream project without spending your own money. That's the idea behind 100% commercial project financing. It means getting a loan for the entire cost of a project. This includes construction, permits, and even the fees for the loan itself. You use the project's future income to repay the loan. This type of financing is popular for large projects like office buildings or shopping malls. It's also used for energy projects and infrastructure. Think of a wind farm or a new toll road. These projects often have long lifespans. They also generate steady income. But getting 100% financing is tough. Lenders take on a lot of risk. They want to be sure the project will succeed. They need to know the income will cover the loan payments. Finding 100% financing is like finding a rare gem. It's possible, but not easy. Lenders are very cautious. They prefer borrowers to have skin in the game. This means investing some of their own money. It shows commitment and reduces the lender's risk. Lenders worry about things going wrong. Construction costs could go up, the economy could change. If income drops, the loan might not get repaid. Despite the challenges, 100% financing is possible. Projects with strong government support are one example. Think of renewable energy projects with tax incentives. A power plant with a guaranteed buyer is more likely to get full financing. Let's look at a real-world example. In 2017, a large solar farm project in California secured 100% financing. This was a $1.2 billion project. It was the largest solar farm in the United States at the time. The project had several things going for it. It had a long-term contract to sell electricity to a major utility company. It also benefited from government tax credits for renewable energy. However, not all projects are so fortunate. A proposed shopping mall development in 2019 failed to secure full financing. The developers were asking for $500 million. The project was in a good location, but it lacked pre-signed leases with major retailers. Lenders were worried about the mall's future income. They were not willing to take on the risk of 100% financing. These examples highlight the importance of strong fundamentals. Projects need a clear path to profitability. They need experienced developers with a good track record. And they often need some form of credit enhancement, like government guarantees or insurance. The big wind farm project we mentioned had several things going for it, including a long-term contract to sell electricity to a major utility company and government tax credits for renewable energy. However, not all projects are so fortunate. A proposed shopping mall development in 2019 failed to secure full financing. The developers were asking for $500 million, but it lacked pre-signed leases with major retailers, worrying lenders about the mall's future income. These examples highlight the importance of strong fundamentals and a clear path to profitability. Weighing the scale's advantages and disadvantages. Like any financial decision, 100% project financing has its pros and cons. Let's start with the good news. Full financing allows developers to pursue bigger and bolder projects. It frees up their capital for other investments. It also allows them to diversify their portfolio without overextending themselves. However, there's a flip side to this coin. Securing 100% financing is a complex and time-consuming process. It often involves multiple lenders and layers of legal and financial due diligence. The terms of these loans can be restrictive, giving lenders significant control over the project. Moreover, the interest rates on these loans are typically higher than conventional financing. This reflects the increased risk the lender is taking. Developers need to carefully analyze whether the potential benefits outweigh the costs. Financial foundations, key principles at play. To understand 100% project financing, you need to grasp a few key financial principles. First is the concept of risk and return. Lenders expect a higher return when they take on more risk. That's why interest rates are higher for full project financing. Second is the importance of due diligence. Lenders conduct thorough research on the project, the developers, and the market. They want to minimize their risk by making sure the project is sound. Third is the role of credit enhancement. This refers to mechanisms that reduce the lender's risk. Examples include government guarantees, letters of credit, and insurance policies. These mechanisms make the project more attractive to lenders. Navigating the landscape advice for seekers. If you're considering 100% project financing, here's some practical advice. First, do your homework. Research different lenders and their requirements. Understand the terms and conditions they offer. Second, build a strong team of experienced professionals. This includes lawyers, accountants, and financial advisors who specialize in project finance. Third, develop a comprehensive and realistic business plan. Clearly articulate the project's revenue model, market demand, and competitive landscape. Fourth, explore all available credit enhancement options. These can significantly improve your chances of securing financing. Finally, be prepared for a lengthy and rigorous process. 100% project financing is not for the faint of heart. It requires patience, persistence, and a deep understanding of the risks and rewards involved. Embracing the possibilities. While securing 100% commercial project financing is challenging, it's not impossible. With careful planning, a strong team, and a bit of luck, you can turn your vision into reality. Remember, the journey might be long, but the rewards can be substantial. So embrace the possibilities and don't be afraid to dream big. And don't forget the equity distribution. The lender retains 40% JV equity. Investor receives 30% vested equity of the project. Mrs. C secondary investors receive remaining 30% equity.